Good evening, everyone, and thank you for joining us as we continue StreetEasy's 2021 Homebuyer Series. I hope you and your families are healthy and comfortable and enjoying this spring in New York. My name is Ian Port. I lead the content team here at StreetEasy, which includes the folks who create all of our guides to buying, selling, and renting. You can find their great work at streeteasy.com/blog, along with our market reports and lots of other great resources. Check it out. I'm coming to you today from my home in Washington Heights, Manhattan, for part 2 of StreetEasy's Spring Homebuyer Series. This week's events are designed to help answer your questions at each step in the home buying journey. Yesterday, StreetEasy economist Nancy Wu gave us a detailed look at the current housing market dynamics in New York. Then, Krista Nichols, a top real estate agent in our StreetEasy Experts Network, gave an overview of the home buying timeline and process in New York and explain the value of working with a buyer's agent when you're looking to purchase a home here. If you missed any of that, don't worry. It was all recorded, and you'll be getting a link to the recordings in your email. You'll also be getting some free swag as a thanks for making it today if you stick around and take a quick survey after this webinar. When the session ends, just fill out the short survey, and we'll send you the StreetEasy swag item of your choice. Now tonight, we're focusing on 2 big issues when it comes to home buying: finances and legal matters. These are definitely serious, maybe not quite as much fun as designing your dream kitchen, but obviously they're crucial to understand. So if you want to know more about loan options, interest rates, or working with an attorney during the buying process, you are in the right place. In a minute, I'll be welcoming to your screens Tony Zhao, a seasoned residential loan officer, who will be sharing some great insights on preparing your finances to buy. Then I'll be joined by Roz Quast, a founder of a local real estate law firm, will help break down what it takes to close on a home and explain how to avoid some of the legal pitfalls that can arise. Before we get started, I want to remind you that after our time with Roz, we'll do a Q&A and address the questions you submitted when you registered for this event. We'll get to as many of them as we absolutely can. So let's get into it. I'd like to introduce Tony Zhao, a longtime residential loan officer at Investors Bank in New York City. Tony is an absolute savant when it comes to mortgages in New York City, and he's here to drop some incredible wisdom on preparing your finances to buy a home. I'll be back after he wraps up. So Tony, take it away.
Thank you so much, Ian, and it's a true pleasure and honor to be here. So as a residential loan officer who has really spent the last 21 years doing mortgages in New York City, I can say it's very different than anywhere else in the country. So I think what needs to happen the second you think about buying a home in New York City, the pre-approval process laid out in front of you is key, because you certainly don't want to spend or waste your time or anybody else's time and not know you have the ability to buy a home, because this is going to be the largest investment of your life. So you want to make sure that you get all the ducks in a row and that you have everything set up before you start that home buying search. So the pre-approval process. Now, what is a pre-approval? The pre-approval is that you are pre-approved to buy a home, meaning that you've gone to a bank or you've gone to a mortgage broker or a mortgage lender. You've provided them with your income, assets, they've ran your credit, and they issue this piece of paper, or it's a few pieces of paper, that states to the listing agent and the realtor that you're working with that the bank has vetted you and they've pre-approved you, so that the buyer's agent or your seller's agent knows that you as a buyer are qualified to get the loan. Now, when should you start this process? Now, think about New York City and how long it takes for you to start from finish to the end for the process. My opinion is before you start putting in offers and talking to realtors, it is vital to maybe start 3-4 months in advance, because you want to hedge any issues you may have as a buyer. Because these days, getting a mortgage may be a little more challenging than before COVID. So you want to make sure that if you have any issues, you have that time to tackle it, because most of us do rent, most of us do have leases. So you want to plan them out correctly. So my advice is 3 to 4 months before you start looking for a home is when you should start getting a pre-approval from a lender, a bank, mortgage broker, etc. Now, when you approach a bank or a mortgage broker, what do they ask for? Now, when banks lend you money, they want to know that you have the ability to pay them back and that you have the down payment and the assets. So income is very important. Pay stubs, if you're a salaried employee, they want to look at your W-2s for the last year or two to ensure that you have the ability to support that mortgage payment. So if you're looking for a pre-approval today, you go to the bank with your 2020 W-2, your most recent pay stub, and if you own any other properties, maybe tax returns, because they do want to know what income you file from those rental income properties. Now, it may be more challenging if you're self-employed. If you're self-employed, think about this. You probably have 2019 and 2018 federal tax returns for your personal and business. But think about what happened in 2020. Banks have no idea how you did business-wise, if your business has suffered or if it's gotten, done well in 2020. So you're going to want to start looking at your 2020 personal and business returns. If you don't, you should start working on something called a profit and loss statement for your self-employed business. Also, for a down payment. Now, part of the Patriot Act asks banks to see and search where the funds for a down payment has come from, because we want to know that the money used for a home purchase did not come illicitly, it was not borrowed, and it came from either a gift through a family member or your own savings. That is very crucial when you're buying a home. They want to know where the assets for the down payment has come from. Now, when a banker gets all that information together, they come up with something called a debt to income ratio. The debt to your income should be 50% of your gross income, meaning your mortgage payment, all of your debt that's on your credit report, and what the new mortgage payment and carrying costs are should be under 50% gross of what you earn. And that's going to be very important, because these days banks look at that exclusively to ensure that you can pay them back in time. So the debt to income ratio is what we as banks look at when we do a mortgage for that pre-approval. And if you can provide that, the pre-approval should take no more than 1 day to issue. Now, when I talk to a new buyer, I always tell them that in New York City, it is very different than anywhere else in the world. Because first off, there's no co-ops outside New York City, right? And buying a home in New York City, I would say the banks place a 70% emphasis on the building you're about to buy in, not you as a buyer. You as a buyer, I would say, account for 25 to 30% of the approval. And I would say that in New York City, there is one of the highest declination rates for loans due to the collateral, which is the project or the condo and co-op that you're buying in. So I'm going to talk about co-op and condos and what projects to avoid, because in Manhattan and Brooklyn and most of New York, co-ops really have a large percentage of the buildings in New York City, and they're usually the most affordable. So with that being said, banks follow these guidelines, because when they're giving you money to lend on a co-op or a condo, they want to make sure that there's no future assessment, meaning that there's an issue with the building and you as a shareholder may have an assessment where they raise your monthly common charges or your maintenance. So the first one to avoid is projects in which a single entity owns more than 20%. Now you ask, why is that, right? Because you have a lot of buildings where sponsors own 20, 30, 40%. Now, if you think about one entity owning a building or a percentage in a building, let's say that entity, which is usually a sponsor or developer, all of a sudden cannot pay their dues. They stop paying their taxes, they stop paying their rents or things that are owed to the building to upkeep the building. What happens is you are a shareholder of this entity. That's going to cause financial distress And that's going to hurt the building's financial down the road, where it's going to cause you to have that magic word, which is an assessment, where they raise your monthly charges. So when banks do a loan, they're going to look at what entity owns more than 20, 30, 40%. And if there's one entity that owns more than a large percent of the building, most likely they're not going to lend in this building. Now, you have projects right now where a developer owns 50, 60% of the building, and 100% of their renters are not paying rent. So could you imagine buying in a building where so many people are not paying their dues? That's going to have an adverse effect, and it's going to come down. It's going to trickle down negatively on the financials of the building. Second, projects with litigations. Litigations, there's a lot of buildings where they're being sued or they're suing somebody. So if the building is being sued, banks want to know why they're being sued and what that is for. Because what if the building loses a litigation for whatever reason and the insurance company doesn't cover it? Well, you as a shareholder or owner of this corporation or the project could have an adverse effect. Again, it comes down to that word assessment. Could you imagine you buying a home and your assessment when you started was $500 a month? And because of terrible financials, litigation, whatever the case may be, they raise it to $800, $900 a month. That's going to have a negative trickle down effect on you financially on all aspects of your life. So when banks lend, they want to know there's no issues with the building itself. Now, you have a lot of buildings where there's 35% commercial space. Do you know how bad commercial tenants are in a jam right now? I mean, they're just not paying rent. So if they own and the building depends on the financials of that commercial tenant who's not paying rent, again, that could cause an ill effect on the building's financial. Projects managed as condotels. There's a lot of condominiums in New York City where it's half condos and half hotels. As we know, the hospitality industry has taken quite a bit of a hit due to the COVID. So what's going to happen is that's going to hurt the overall financials of the building. So banks usually will not lend in a building where it's considered a condotel. Another thing to avoid is projects where 50% of the units are investment properties. Now, think about what's happening right now. And if you have a building where 50% of the renters are not paying rent, then the people that own those units may have financial difficulty. They may not be paying rent, they may not be paying their mortgage or the dues to the building. And like I said, it all comes down to the assessment. They're afraid that their mortgage holder is not going to be able to pay the mortgage because they're having issues with the building. And lastly, you know, in New York, there's a lot of buildings that are currently sitting on proprietary leases. And what a lease is, the building builds on leased land. So every 30, 40, or certain amount of years, they have to get that lease renewed. And banks are afraid that when they go renew that lease, the folks that own that underlying lease could say, we're not going to renew the lease, or we're going to raise it by 1,000%. That's going to wreck the financials of the building. And you do see that once in a while in New York City, where there's also litigations that happen. So those are things that buildings, banks in New York try to avoid. So as a buyer, if you're about to buy a home, or if you're currently in contracts, I'm going to tell you that after you get your pre-approval, that does not mean the bank is ready to close. They're still going to take 3, 4, 5 weeks to do their due diligence, background checks, things of that nature. And for you as a buyer, these are all things that you must do to ensure you get to the closing table. Obviously, pay your bills, right? Because what happens is the bank's going to run a credit at the time of the pre-approval. They're going to run a soft check prior to you closing, because they want to make sure that you have not taken out any new debt. They want to make sure that your credit has not dropped significantly, or you stop paying your credit card payments. because that's going to have an adverse effect on your credit score. Obviously, keep paying your rent. If a mortgage company or a bank is going to give you hundreds of thousands of dollars, they want to make sure that you are currently paying your rent. So they do a verification of rent prior to closing. And if you've not been paying rent for the last few months, chances are the bank is going to not give you that mortgage or decline you. Remember, they have the ability to decline your loan last minute without recourse, and it states that all over the commitment. Keep working. Obviously, that's something that is extremely important, because if you don't have a job, if you don't have a paycheck, you're not going to be able to pay us back or pay the banks back. And I got a silly story, and it's actually pretty terrible. A client was about to close a week before closing. The bank did a verification of employment. Well, that verification of employment came back that the borrower was just laid off. And even though he was laid off, he was still receiving pay stubs. So he sent us pay stubs. But when that happens and we find out that in 3 or 4 weeks, he's not going to get more pay stubs, or he's not going to have that ability to pay us back, then we can't approve the loan. So we pulled the loan last minute, and luckily he found a new job and we were still able to close with a small delay. But banks, because of COVID, are doing a 5-day prior to verification of employment to ensure that you are still working, because without a job and without money coming in, you probably won't be able to make your mortgage payment. Save your pay stubs. Banks want to see what your year-to-date is. They break it down to taxes, etc. if you have loans on there. So saving your pay stubs are key. And I think asking your lender questions as much as possible during the process is something that you need to do. This is your biggest asset. It is very, very anxiety inducing. You need to make sure that you don't lose sleep at night. You need to make sure that the lenders you're working with understands New York City, understands condos and co-ops, and that things don't go awry at the last minute. So if you have to ask that loan officer 100 questions a day, do so. That's their job. So don't for a buyer. And I want to say a lot of it is common sense, but believe it or not, a lot of folks still make these mistakes, even if we talk about it during the process. When a bank does your loan, they're lending you money based on how much you make and how much debt you have. So if you go out and you buy a new car with $1,000 a month payment on it, that's going to have an effect on our debt to income ratio. And you certainly don't want to start pulling credit, buying appliances, furniture before closing and racking up debt, because that's going to drop your credit. Do not apply for new credit cards, because remember, every time you apply for a new credit card, they are pulling credit. And when they pull credit, and when we do a final check before closing, that's going to drop 30, 40 points. And the lower your credit score, the higher your interest rate. And I think most folks don't realize how much a bank vets your checking account statements. Remember what I said in the beginning about the Patriot Act? Well, we have to make sure that the money you're using to buy a home is not coming from illicit transactions. It is not being laundered, that you can source it. So if you have money moving from account A to account B, you need to show 60 days of bank or statements from account A and account B. Every penny coming in has to match coming from somewhere, unless it's a gift from a family member. Remember, the banks get audited on each purchase transaction. So you need to make sure you have all the documents ready, and try not to put in large numbers, especially on the cash end before closing, because after closing, we do get audited, and it is very, very important that you do not get declined, because 2 weeks prior to closing, you deposited $30,000, $40,000 that are sitting in cash. I can tell you people do that often, and you do see some folks not have the ability to get to the finish line, which is getting that denial because of large deposits. I think that is something that I do see often. So be sure before you make any financial transactions in your checking, savings, brokerage account, that you talk to your loan officer and find out what you can and cannot do. So I think co-ops and condos and single family homes, I mean, they are so different from each other, because when you're buying a co-op, the closing costs are negligible. When you're buying in a condo, single family home, you have astronomical closing costs comparatively to anywhere else in the country, right? I mean, a transfer tax can be 1.9%. You have a mansion tax of 1%. So when you compare buying $1 million home in, let's say, New York versus somewhere in Ohio, you're talking about a huge difference. Now, in a condo, everything is very similar to a single family home. You have to buy title insurance, there's municipal searches, there are recording fees, and sometimes on a new development, you actually have to pay the transfer tax for the sellers unless you have negotiated that, plus recording transfer taxes and recording taxes. So on $1 million or $900,000 condo, your closing costs could exceed 4 to 6%, depending on what type of property it is. So when you're buying a home, aside from your 20%, you need to set aside the closing cost of reserves. For a co-op, it is very minimal. Your taxes are usually on the flip side when you sell it. So, I think Roz will talk about closing costs, because I usually just, ask them to talk to the attorney about closing costs. I can tell you what they are on the bank side. They're going to be negligible, $2-3 grand, but most of the closing costs are going to be third party and tax related. And, I think interest rates have gone from one end to the spectrum to another, because prior to COVID, rates were at 3.875 to almost 4.25, right? And for most of last year, I was locking in a 30-year fixed at 2.5%, which I've never experienced in my entire career. So I think if you talk to bankers now, they're telling you rates are at 2.875 to 3%, depending on your scenario. And nobody has a crystal ball in front of them. So nobody knows where it's headed. But you say to yourself, and relatively speaking, if you don't buy something now, what if rates do go to 4%? Would you be more upset that you didn't lock in a rate and rates went up, or that you locked in at 3 and they went down to 2.875? Because chances are rates will probably never go back to 2.5%, but who knows, right? And a lot of folks, even folks that work on Wall Street that I talk to, say, hey, I'm going to hold off on locking because I think the feds are going to lower rates, or they're going to keep it where it is. Well, mortgage rates are not tied to the Fed fund rates. They're actually tied to the 10-year Treasury bonds, or they're tied to geopolitical and economic events. So I think rates have gone up and down, and you've seen large swings. I would say 0.5 point to almost 100 basis points from where they are, but the Fed fund rate has not moved much, if at all. So remember, lock in your rates as soon as possible. I don't know where they're going to be headed, but my opinion is it's going to start. And that's it for my part. Thank you.
All right, Tony, thank you. That was awesome. I think we all know a ton more now about the process of getting a mortgage in New York and what to do, what not to do. Don't go out and buy an RV while you're looking at buying a co-op. So thank you, Tony. Appreciate that. Hope everyone's feeling better prepared. Tony, we will see you later for the Q&A portion. I'm sure you're going to get lots of questions. All right. Now that we better understand the financial picture of buying a home in NYC, let's get a handle on the legal process. To help us do that, I'm excited to welcome Roz Quast, principal attorney and founder of the NYC firm Quast Law. Roz, how's it going?
Good. How are you? Thanks for having me.
Thanks for having it. Thanks for coming. Maybe you can get started by just telling us a bit about what role the real estate attorney plays in the home buying process. That's not usual everywhere. It's common here. What does a real estate attorney actually do?
Sure. So the real estate attorney is extremely important, at least in New York City. So before a contract is signed, the contract is negotiated by the attorney, and also due diligence is conducted by the attorney. After a contract is signed, the attorney needs to make sure the client buyer is aware of all their deadlines, and also they need to explain all closing documents and all ancillary documents to the client. After an approval is received from the co-op board or a condo board, then they have to actually schedule closing, and they are the liaison between the seller, the seller's attorney, the co-op or condo, and the bank side.
Got it. Okay. Wow. So when should a buyer look to get an attorney involved in their process?
Sure. So there's two lines of thinking with that. The first is you must have an attorney once an offer is accepted, because that attorney has to negotiate the contract. They have to conduct due diligence. But a lot of people should try thinking of getting an attorney even sooner than that. So once they start thinking that they might give an offer, or they might start looking for an apartment or a house, it's a really good idea to start speaking to an attorney, just because they can learn and educate themselves on the process. The attorney can discuss with them what kind of offer they might be able to submit, whether or not it's contingent on financing or non-contingent on financing. And that sort of conversation then translates to the ability for the buyer to then speak with their agent to negotiate a better offer. Having an attorney on board in advance of submitting the offer also looks better for a buyer. They look like a more serious buyer, and it might actually fast track the whole process and get them the deal rather than another purchaser.
Got it. That's a great tip. Thank you. Do buyers need to have an attorney?
Yes, in New York, you have to have an attorney. Other states, you don't have to have one. But in New York, it's pretty important because the attorney conducts the due diligence and they negotiate the contract.
Got it. So you need to have one.
Yes.
What kinds of skills or backgrounds should buyers look for in a real estate attorney, and how would they go about finding one?
Yes, so a real estate attorney usually is referred to by the agents or friends. And when you're speaking to one, you want to make sure that they specialize in transactional real estate. You want to make sure that person has experience in contract negotiation and not necessarily in a courtroom. So you want to find out if they also litigate on the side, just because transactions in New York City are very time sensitive. A lot of transactions, especially now in a very busy market, have deadlines. So you want to make sure that the attorney's not in court all day, and that once a contract comes in or a deal sheet comes in, they're going to be on it. They're going to negotiate the contract and get things done in a timely fashion.
Got it. So folks should look for someone who specializes in real estate contracts, not just any kind of lawyer who says they can maybe do it like your friend's cousin or whatever.
Exactly. Exactly.
Got it. Okay, great. Well, talk to us about due diligence. You hear this term thrown around a lot. What exactly is that?
Yes, so due diligence is when the buyer's counsel actually delves deeper into the building, the unit, and digs up information that the purchaser is going to want to know before they become an owner. So number one is going to involve reading the board minutes. So if a buyer is looking to buy in a condo or a co-op, it probably have a board. The board usually meets on a monthly basis, at least annually, and the minutes reveal the personality of the board. They might indicate that they're more white glove, or they're more casual. And so if there's any issues with the line or the floor that the unit is in, the attorney can see that and let the client know. The second part of due diligence is reviewing the offering plan. The third part is reviewing the building financials. And typically speaking, most attorneys should look at least the last 2 years of financial statements to make sure that the building is operating where it should be, and also to take a look at what they're spending their money on. The last part of due diligence, the fourth component, is for the attorney to draft up a custom questionnaire that is sent to management to answer the most important questions that the buyer might want to know before they make the investment. Some of the questions might include if there's a history of assessment increases or maintenance increases, if the roof is doing okay, if the boiler runs on gas or oil, because a conversion can indicate a costly assessment down the line. You want to know that the maintenance that's actually listed on the listing is accurate. Sometimes the listings are not always accurate, and it's up to the attorney to find out and confirm those items.
Great. So what does a buyer need to do during due diligence? Is there anything for them to do or to know about it, or does the attorney kind of just handle it?
The attorney handles it, but if there's specific questions that a buyer has, for instance, if they are going into the unit knowing they want to renovate, they're probably going to want to find out if there's an alteration agreement, if there's a decorator's agreement, and that way they know and they're equipped with information before they sign the contract.
Got it. So the buyer can just trust that the attorney will let them know about anything that comes up in due diligence that is potentially an issue.
Yeah, the buyer's attorney really needs to flag any kind of issues or concerns. And if there is a red flag, they should let the client know.
Got it. So we hear it said that New York is a buyer beware state. What does that mean?
Correct. So buyer beware just means that the buyer or purchaser of real property or a co-op needs to be responsible on their part for figuring out what they need to know before they either sign a contract or make the purchase. So that involves really the attorney conducting the due diligence on their behalf.
I see. So in other words, it's your responsibility as a buyer to find out everything about this potential unit and building, anything you might want to know. You're the one to find it out. They don't have to tell you.
Correct. Correct.
Got it. Okay. All right, let's get to the closing. So this is kind of like the big finale of the transaction. Can you tell us a little bit about how a closing works and what buyers can expect going into that?
Sure. So the actual closing itself is anticlimactic just because everything has been done leading up until that point. Usually it happens at a table, all the parties are sitting together, the closing documents are given to the buyer's attorney, tax documents, co-op and condo documents, bank documents, and they're explained to the buyer on the spot. The buyer, if everything meets their approval, they sign, they get notarized, and then the checks and the keys are handed off. So that's kind of what happens when you're actually at the closing.
Got it. And how does it work to choose your closing date? Can buyers set a closing date? How long will the closing date come after the contract's signed?
Sure. So New York is the only state where you enter into a binding contract, the contract of sale, before you actually know the specific closing date. Every other state, you sign a contract, you have a specific date, and if you don't close then, you get penalized. For New York City and New York in general, the closing date is always considered a on or about date. So on or about, usually 60 days from when you sign a contract is when you can expect to close. On or about allows either party an automatic 30-day delay period. So then you really have between 60 and 90 days to close. And that doesn't include any delays on behalf of third parties, such as the co-op board. So if the co-op board delays in issuing an approval, you could delay beyond that 90-day mark. So once an approval is actually issued, and the lender is cleared to fund a loan, then the attorney reaches out to all the other parties, management, the seller side, the bank side, to decide on a date that works for all parties. And this date then really usually happens between 2 and 4 weeks after an approval. So during that time frame is when a buyer can actually, at that point, choose a closing date.
Got it. Okay. So we talked about the due diligence process. What happens to the closing if the attorney uncovers some bad stuff during the due diligence, some issues with the management or the board or the assessments, things like that? Can buyers exit the closing process, or how does that affect the closing process?
Absolutely. So basically, because New York is a buyer beware state, all due diligence is completed before a contract is signed. So even if an offer is accepted verbally between the agents, once that offer is printed on a deal sheet and given to the attorneys then have to negotiate the contract, conduct the due diligence. And if there's something that's a red flag, there's no obligation for the buyer to sign. At that point, they can excuse themselves from the transaction. There's nothing tying them down to the contract because they haven't signed anything, and they just move forward to find something else.
Got it. So that's why it helps to have an attorney.
Exactly.
Great. Well, Roz, you've been doing this for a while. Do you have any final tips to share with our audience today when it comes to buying a home in New York City? What would you advise them from a legal perspective?
Sure. So New York is very different from any other state. And because of that, I would say, trust your team, make sure that you plan in advance, like Tony said, make sure that you have your team, you've looked at your financials months in advance, and then when the time is right, just go for it. You don't want to hesitate too much, because if you do, you might lose out on a property that you really like. Things move very quickly in New York. It's very different from other states.
Awesome. Well, thank you, Roz. This has been so informative. Appreciate you walking us through the process of closing and what to expect from the attorney, and the fact that we need an attorney and all that. I appreciate it. At this point, we're going to jump into questions from the audience. So let's get Tony back onto the screen and dig into some of these questions. Welcome, Tony. All right. So over the course of this week's home buying series, we've spoken a lot about the team. Denise wrote in and asked, I've heard that I should have a team in place before I get serious about my search. How important or true is this? So I'll let each of you weigh in first. Tony, you want to handle that first, and then Ross, take over?
I think it's extremely crucial. You need to have your team in place, especially boots on ground, similar to somebody who, practices real estate law specifically in New York and Brooklyn, like Rosalind, right? Because they're there to protect you. Remember, New York, you're giving the sellers, 10% of the sales price. So they're going to hold on to that money. So they need to know, or you need to know, that you have somebody legally that is going to protect your interest. God forbid something does happen, you want assurance that you have the ability to get your money back. And, I don't think all banks are created equal, because if you think about the percentages of banks that actually do co-op lending or, new development lending, that is probably less than 1 or 2%. I'm making that figure up, but it's a very small fraction of the mortgage market. And not most folks understand the nuances of a co-op. So you need to make sure that you work with a team, like I said, boots on ground, that understands New York City, because it is unlike anywhere else in the country.
Yeah, I would agree with that, Tony. In addition to what you've said, it's really important just because a buyer needs to educate themselves on the process. And if they have their team in place before an offer is accepted and when they're starting their search, they're that much more well equipped to get an accepted offer at a place that they want. In addition, it's going to help with them negotiating the deal that's actually accepted. And also they just look more serious. They are more equipped to move the deal forward more quickly and on time. And so they don't lose out on another accepted offer.
Great. Makes a ton of sense. Thank you. All right, Tony, this one's probably great for you. How do you decide which mortgage lender to go with?
Well, it's certainly tough. I do want to say that I probably get about 10, 15 calls a day from potential buyers, and the only thing that matters to them is rates. Now, rates are important because that's going to determine your mortgage payment for the rest of your life. But like I said, New York is so specific. You have lenders in different parts of the country who has never lent in New York City. And just because somebody tells you what the rate is does not mean they can get you to the closing table, because regardless of what rate they're offering you, if they can't close, that rate means nothing. So I think the most important thing is usually checking with an attorney, the listing agent, or the buyer's agent. Who do you recommend? Can you give me a list of 2 or 3 mortgage folks that understands this building specifically, or geographically the area that you're buying in? And those realtors, right, they've been to this rodeo before. They know who can do what, and they're going to give you a list. And you shouldn't just call a lender and say, what's your rate, right? You can't call a physician and say, hey, here's how I feel. Can you diagnose me? That doesn't work. So a banker needs to vet you thoroughly. They need to go through information before they can give you a final rate. So I think going with a list that your realtor, your attorney provides will save you a lot of heartache with going with the wrong mortgage lender.
That's great. And yeah, it's a huge difference here in New York, where it seems like, your lender is really a lot based on your building. You're going to want to help maybe choose your lender in large part based on the building, right?
Absolutely. I mean, look, we're in New York City, and I think we have a lot of high earners. Most buyers have great credit. Most buyers have great assets. And like I said in the beginning, you have a lot of folks in New York City that have been declined for the mortgages, not because of their ability to get the loan, but the building's ability to pass the bank's guidelines.
Great. Kara asks, is it harder to secure financing for a fixer-upper? And what are some watch-outs when shopping for a reno project? Who wants to jump in on that?
A fixer-upper usually means it's a construction loan. And, very few banks do construction loan. A construction loan is a temporary loan. They're going to give you money at a higher rate for either 12 or 24 months, right? Now, all banks get their residential lending money from a few sources, mainly from Fannie Mae and Freddie Mac, the Federal Reserve, or the Federal Home Loan Bank. So they say a residential mortgage, when you issue it, that property has to be in livable condition, meaning after you close on it, you have to have the ability to move in, because they don't want you to buy a home where it needs $100,000 or $200,000 in renovation costs. Because what if you can't afford it? Now you're not living in the property, you're living and renting and paying for rent on your property elsewhere, and that's going to cause a financial hardship for that buyer. So renovation projects are usually what you call a construction loan. They're short term and they have a balloon or interest only payment after a certain amount of time. When you get a traditional financing from a traditional bank or mortgage broker, that property has to be in livable condition. And how the banks find out if it's in livable condition is when we send an appraiser. The appraiser is going to go to the property, take pictures for the bank, and it's going to show that it's in livable condition.
All right, thanks, Tony. Roz, is there anything you want to add from the legal perspective on folks who are maybe looking for a rental project or a fixer-upper?
Sure. So in my experience, if someone's doing extensive work, they're doing a gut renovation, they're not going to be able to get a regular homeowner's insurance policy. It's probably going to be a builder's risk policy, which is more expensive. So they're going to want to speak to their insurance broker on that.
Got it. Thank you. Lots to know there. So yesterday, our economist, Nancy Wu, spoke a lot about the busy housing market in New York right now. And Hannah Z asks, I'm hearing that buyers are very aggressive. As a buyer who needs a mortgage and wants to protect that 10% deposit, what should I do to compete so that I don't lose the deal? So how do you get into this busy market knowing you only want to put down 10%?
I think that there are certain ways, and I'm going to let Roz talk about contingencies, right? Because there are different contingencies that you can waive. One is waiving your appraisal contingency. And waiving your appraisal contingencies means I'm going to, no matter what, buy the property if I can get financing from a bank, even if the appraised value is not what the sales contract came in at. Remember, the banks will lend on the lower of the two. So if you go in a contract on a $1 million property and the appraisal comes back at $900,000, the bank's going to give you 80% of the $900,000, not the $1 million that you're in contract for. So there's contingencies that you can waive that still protects your 10% deposit. You can also do something called a pre-commitment, meaning you're going at a bank with all the traditional documents, getting it to an underwriter, a credit officer, having them sign it and say, hey, I'm going to get this loan approved no matter what, so that you can show the sellers that you've already submitted all your documents. Now, that's very different than a pre-approval. A pre-approval takes less than a day to issue. A to-be-determined commitment is a true commitment, but just without the property address in there. And it does take 5 to 6 business days because it does go to an actual underwriter instead of the loan officer who approves it. And I'm sure Roz can, you know.
Definitely. So it is a very busy market, and I'm seeing a lot of buyers ask the same question, how they can be competitive, but also protect their deposit. So the one thing that you want to do to protect your deposit is ask for a contingency. So it's called the financing contingency. And like Tony said, typically that protects the buyer in the event that they do not qualify for the loan, and if the unit underappraises. However, you can ask for a carve out of the appraisal contingency from that financing contingency. So that way you take on the risk of a lower appraisal, but you still have a contingency related to being able to receive a commitment due to your own financial ability. So waiving the appraisal means that in the event the unit underappraises for a certain amount, you're still going to move forward because you have that padding somewhere that you can pull money from. So that's one way of being able to be competitive, but also protect your deposit.
Our final question today is for you, Roz, from Sun K, who asked, how do I avoid any future surprises when it comes to maintenance or HOA fees and common charges?
Yes, so this is an important question related to due diligence. When your attorney conducts due diligence, they should be asking if there's any upcoming capital improvements, if there's any capital improvements currently underway, and if the building is letting you know they have an elevator modernization project or they have to do some facade work, but there's no current assessment and they don't have that much money in reserves, then there might be the possibility of an assessment in the future or an increase in the maintenance to make up for the difference. Having just the facts presented to you from the attorney is going to help you understand what costs you might incur in the future. If the building has already done a lot of capital improvements, they've just finished maybe a whole section of the building, or they upgraded their boiler and there's really nothing else to do and there's no capital improvements coming up, then it's probably safe to say it's unlikely there's going to be an assessment in the future. But obviously, this kind of information changes year to year.
Great. Thank you very much. All right. Thanks to you both. Unfortunately, we are out of time. I hope everyone's learned a little something this week and in today's session and feels better prepared to navigate the buying process in New York. If you're looking for more advice and help with buying a home in New York, I strongly advise you to visit the StreetEasy blog at streeteasy.com/blog. Also, one last plug to please take our survey, which will appear right after the webinar ends. Get your voice heard and get a free gift from us at StreetEasy. Thank you again to Tony and Roz for your time. We really appreciate your insights and help today. And thank you all out there for tuning in. Have a great evening and enjoy the rest of your week.